Welcome to the Commercial Real Estate Podcast powered by First National. I'm Aaron Cameron. With me, of course, Adam Płatek. I'd like to thank Kingset Capital for sponsoring the video series as we sit here recording live at the Canadian Apartment Investment Conference. Our guest for this episode is a gentleman named Niall Finnegan, who works at Finnegan Marshall. You'll notice I didn't have a title there, because, and we'll start here because I think that's interesting, and then we'll go backwards. But no titles at your institution.
Correct. Over the years, having different practices, I found that titles can be a negative impediment to unity in an office, and I don't know how long more we'd be able to keep it last, because we're up to close to 50 people, 45, 50 people now. But
the intern shows up, sits down at your desk, goes, "Well, I sit here now."
You know, all the staff know who's important, who's not important. They're all important, but yeah.
I like it. No, I for those who've listened to the podcast many times, I'm always talking about culture and how you develop different things. It's a very important aspect of a successful organization, and something like that is just one component of having a strong culture. Okay, let's go back. How did you get into real estate? What was your first experience in construction? Just talk us through kind of your career trajectory.
Well, I was educated. I was born, educated in Ireland, in Dublin, and I came to Canada when I was 22. I did a course in Ireland called Construction Economics. Very intense. 25 people only in the course get in each year. Cover a multitude of subjects, not just construction pricing, but you do law, you do financing, you do services. We did accounting, how to conduct yourself in business and such. So it's very, very intense. I came to Canada right after university. I left mainly because I wanted some adventure in my life. I applied to Australia, I applied to Canada, and I got accepted in Canada. I got a job in Winnipeg. I had no idea where it was. I was told it was in Canada with 600,000 people, and that was good enough for me.
What year was this?
1981. And I came, to be honest, a little funny story. I accepted the job over a phone call, and the first thing I did was I went and grabbed an atlas to try and figure out where Winnipeg was. I looked around Toronto, Montreal, which I knew of, and I looked out on the west coast because I knew of Calgary and I knew of Vancouver. I couldn't find Winnipeg.
Had you never heard the word Winnipeg before this job?
No, never heard it. And so you got to remember, this is before Google and internet and everything else. So I got the atlas, and I went to the back of the atlas and looked up the longitude and latitude for Winnipeg. And I went back and I said, there it is, right in the middle. That's great. I'm right. I can go to New York one weekend. I can go to LA the next weekend. And I had no concept of distance, and I had a great time in Winnipeg. A lot of people, say negative things about it. I think most of those people have never been in Winnipeg. I had 4 years there, great years, great friends, and it was my introduction to Canada. Then I moved to Toronto. I came out here for a long weekend to see a David Bowie concert.
Awesome.
And got an interview and got offered a job, and moved to Toronto, and that was in 1985. Then I worked for a company then called Hellier, who were a smallish company at the time in Toronto. We had around 9 people. I think I was the 9th or 10th person into the office, and over the years we grew it to about 180 people.
Was it construction management? What was it?
It was a construction cost consulting company. But basically, when I joined it, one of the people who became my partner is John Fleming. He was already a partner there. He actually invented, and I'm going to use that term because that's what he did. He invented project monitoring. Right? It never existed, and he was asked to sign off on I think it was a Citibank job, CMHC funded, to sign off on an advance certificate, and he said he refused to do it. He says, I can't sign off on that. He says, in order to sign off on that, I need to know what the contracts are, I need to know what the costs are, I need to get all the backup. And I said, well, architects sign off on this. And he says, well, they don't know what they're signing, because these are just numbers on a page, and they've no concept of what the backup is. So out of that, he got hired on the job, and all of a sudden we created this service at Hellier called project monitoring for lenders. Nobody else did it. It was just us. There was, and we, it grew, and we started working then for all the lenders. And it was sort of up until 1990, when the crash happened in late '89, early '90. It was really only our company who did it, Hellier. And then in the 1990 to 1995, when things were, it was the worst recession.
No one building anything.
Yeah, I mean, people talk about it being tough right now. They have no idea what it was in comparison to 1990 to 95. Although we'll go back to where it's at now in due course, because it's deserving of some comments. Anyway, then that's when other people started doing project monitoring, because they'd know other work, right? So they started trying to do work for banks. And then, I was with Hellier until let me get this right, 2005. So 2005, we, as I said, we'd grown it to about 180 people. We had offices here in Toronto and in Vancouver, and that was really it. We really had two primary offices, and we merged with two other companies of equal size at the time. So the three of us there was ourselves, there was Altus, and there was Derbyshire Viceroy, who were a realty tax company. And we merged and took the company public on the TSX as an income trust, if you remember those things. And we called the company Altus Hellier, and then after a few years we dropped the Hellier name, we called it Altus. And I stayed there for 6 years. I ran the cost division. All the original partners sort of left after 6 years. Two of them left after 3. It was 4 of us really. There was 2 of them left after 3 years, which was the minimum, and myself and another guy stayed for another 3 years. And then I started Finnegan Marshall 2 years later, once the non-compete was over. And during those 2 years I was in non-compete, I was basically acting for a lot of family, high net worth families, family offices here in Toronto, who are heavily invested in the high-rise residential real estate marketplace. But they liked the returns, but they really didn't know what they were doing, and they would be putting up most of the equity for developers, and they just wanted someone to look after their interests. And then I started Finnegan Marshall with my colleague Ken Marshall. Ken had succeeded me at Altus as president, and he left after about another year or so. And we got together and talked about what type of company we wanted to have, and that's evolved into Finnegan Marshall, which is a very we like to regard ourselves as a very, very proactive company that gets involved very, very early in projects. You're both lenders. Our cycle on a project might be 6 years. 2 or 3 of those years might be pre-construction, and 3 or 4 of them are during construction. So we sort of like to be involved right from day one when owners are looking to buy land. During due diligence, does it make sense? Does it not make sense? Because that's a major decision. And then we stay with it right through to design stage, the pre-sale stage if it's a condo. Obviously, definitely before it goes to a lender, because everybody wants to make sure it's right. The lender wants to make sure it's right. The developer wants to make sure it's right, and minimizes equity calls down the road. And then we stay with the project right through until completion.
So we're lenders, and so we obviously engage with QSs across the country on all sorts of projects. First National, we have over 100 construction loans on the go right now. So we're engaged with cost consultants on 100 different files at all different stages across the country. One of the challenges we have at times is the information that we get and the quality of the information that we get, the timeliness of the information sometimes seems to be inaccurate. And I don't think that's on purpose. I think part of the challenge, this is where I'm getting with this, is that the fees that are being charged for this seems so minimal. It's almost impossible to truly do a full due diligence on a report on a draw by draw basis. Maybe, and I'm not asking you to comment on why or what, but maybe just talk about the history of the amount of effort that goes into a draw reports and how it seems to be commoditized almost to a fault at this point.
Well, you forgot to mention too that Finnegan Marshall is one of our preferred cost consultants.
Sorry, thank you. I said that offline.
This is not an airing of grievances.
No. And we should make that a real clear. And I told Niall that already, but you guys do the best. I think you actually are one of the most expensive also, on top of that, but probably because you have to charge to be able to do the proper work. I'm just curious how that frustrates you.
Yeah, well, it obviously frustrates me, but I don't let it get to me because I've accepted it, and I'm not here to make any comments about what other companies do. I'm just here to talk about what we do, and we are, we're only going to do a job one way, and that's right, and our fees are what they are, what we need in order to do it. And if people don't want to pay it, we understand it, and we wish them luck, and we won't work on it and compromise our standards. So that said, and this is true, my line to clients, owners, I should say, developers, borrowers, whatever, is that, okay, look, I'm happy to work for nothing if you pay me a percentage of what I save you. And I mean, like, it's pittance what we charge in comparison to the value that we bring. And I've been in this business for 42 years now, and I got 13-year-old twins, so I'm not going anywhere for a while. And so we developed very deep relationships and trust. And to me, that counts for so much. The people we work with know what we can do. They know the value we can bring, and we charge a fair price, and we just move on with it. As far as what we do for monitoring, I think one of the reasons why a lot of owners like to work with us is because of the value we bring. Like we do things that other people I don't do, that I'm aware of. We negotiate contracts with trades. We know all the construction manager. We know who's busy. We know who's not busy. We know what. People say, well, did you check the prices with the trades? I said, we never check prices with the trades. They're going to tell you what they want you to hear. We're going to tell you what the market is. We got 240 projects right now under construction in the Southern Ontario marketplace. Most of it in the GTA.
So you know what the costs are.
We know what their costs are, and what all their competitors' costs are, and there's different costs for different people. This is not. You can't pick up a book and find out what the right price is. It doesn't exist. There's different prices for different people, for different projects, for different locations. There's no one size fits all. So what do we do? I mean, when we get involved, when we get involved, we like to do the whole pro forma. Sometimes people just ask us to do the construction costs, and we'll do it, but it's probably on 5 or 10% of our jobs. We're doing everything. Hard costs, soft costs, land, obviously, revenues, financing, capital stacks, because you got to understand the entire project before you can give the proper advice. If you only understand the construction components, you're missing the big picture. So we get we get a lot of dirt under our fingernails. We get right into the weeds, building up everything from scratch, because that pro forma, people are relying on it.
The accuracy.
Lenders are relying on it. Developers are relying on it, and it's something that weighs on you. So we our people work hard. I work way too bloody hard, but you wear it on your on your shoulders.
One more question on this, because it is interesting, as you know, from our perspective as lenders. You're in a bit of a rock and a hard place at times when, obviously constructions never go exactly as you plan. There's always going to be challenges to overcome. Sometimes a lender believes the way it should be done is different than the
Reality?
different than the developer, right? And there's this odds between the developer and the lender, and you're kind of in the middle. How do you kind of balance that? And what do you see kind of the role as the QS from your perspective?
Well, the business decisions we leave to the owner and to the lender, right? We're just there to give the facts. If they want our opinion, we'll give it. But we're there to say, this is what it's going to cost. This is what it's going to cost to finish, which is critical. Here's where the revenues are going, and the whole conflicts don't arise if you're just dealing with the facts. And it's do you get undue pressure from borrowers, owners? Occasionally, yes, you do, but we just don't accept it, right?
And maybe just for context, I can tell you from First National, from the lending perspective, at times we'll get a report, not from Finnegan Marshall, from maybe somebody else, let's say, where the interest reserve that's part of the budget hasn't increased, yet rates are up 150 basis points or whatever. And we go, oh, hello, obviously this interest reserve needs to be adjusted. And the response has been, well, I was kind of asked not to do that.
Yeah. Okay.
And we go, okay, well, thanks for your help, but that's just not fact. It's not reality.
Yeah.
You could have had the borrower to submit it directly in that case.
Yeah.
Look, what I would say is being involved on most of our projects, even before a lender gets involved, right? And so we know the project and such. If we don't see a problem coming down the road 4 or 6 months away, we're not doing our job. If there's a problem, we can see it. Okay, there's going to be an issue here, and that's the time to have the dialogue. And you're lenders, so you want a successful project, and you want a client that's happy, and you want to do repeat business. So dialogue is very important. You also know that construction is a very fluid business, and trades have to get paid every month. And if trades don't get paid every month, it impacts the project. And if it impacts the project, it impacts your security. So if there's an issue coming down the road and you see it, what we do is we flag it first to the owner in case he's got some solutions that he's already considered, or some fat in other areas of the budget or such. And we say, look, your rebar ratio's gone crazy. We're gonna the reinforcing steel. I know you're only 40% complete, but we can see, right, and it's a unit rate contract. We can see it's going to overrun by $1 million, say, for argument's sake. And are you aware of this? Oh, thanks for bringing it to our attention. Often is the answer. Let us leave it with us for a couple of weeks and let's see what we can do. That's so we don't raise a red flag to the lenders because it's 4 or 5 months down the road.
Understood.
And we're trying to be proactive. And very often they come back and say, okay, this is what we got to do. And we'll look at it and, okay, that makes sense. And we'll change those line item budgets, but the overall budget's okay. And to the extent that it's not going to get resolved, then you gotta run the flag up. But you're running the flag up in time, so as you can start having a healthy discussion, because you also, I know what the loan agreement says. It says kicking in equity, but you know that a lot of these, borrowers naturally don't have it sitting in their genes.
Of course.
Right? So
yeah.
Or if
so
it
you
is,
got to
they don't
talk
want
about
to,
it.
yeah.
How is it going to get resolved? And so that's how we deal.
Yeah, and the
with things.
transparency to have people to have those conversations open and have the open communication. That's the ask. So here's a plea to all cost consultants out there: just be open and transparent. And we'll figure it out together. We'll work all together. It's the why didn't you include this? Oh well, sorry, right? That's the challenge that we have. Okay, let's pivot because we want to talk about just the industry at large.
Cost escalations, yeah. I
Yeah.
mean, what problem? But in this case, we want facts and opinions from you on cost escalations. And you mentioned seeing problems 4 or 5 months out, so maybe we can kind of segue into that about what we're going to see industry wide. Any problems on the horizon impacting construction projects that are 7 months into a 24-month build. But cost escalations, you must be sick of talking about it by now because it's been multiple years now of that being I assume the predominant conversation point in your line of work. But we'd love to hear your thoughts on where we are.
Take interest rates out. So we're sitting in the apartment conference. So let's kind of focus a little bit on apartments, but we can include condo too, because that's part of the housing crisis that we're facing. We need supply. We need lots of supply. A lot of our clients, your clients and our clients, are talking about just pens down right now. They can't make the pro formas work. Interest rates aside, hard costs or soft costs give you more concern about what's transpiring over the next 6 months, 12 months.
One quick point on interest costs, though.
Sure.
And you want to talk about purpose-built rentals, so everybody's excited about the run up in rents on one side of the balance sheet, but as I say, remind them, the run up in interest rates is a hell of a lot more.
Absolutely, it is. No, you're talking to lenders. No, we know.
If you take prime plus one at what it was at the low, which would be 3.45%, 2.45 plus one, and now it's 8.2. That's 140% increase, right? So, just to keep it in context.
And that's why I said interest rates aside, because I know obviously that's the major
driver. Aaron tries to brush it aside, but yeah,
it's this year's topic, right? So last year, you're correct. It was construction costs and DCs predominantly, and land values. In order to talk about construction costs, you gotta. It's important to understand a few things. First of all, construction is a lagging indicator. It reacts to demand. 6 out of 7 apartment units that are built are condos, and 1 out of 7 is a purpose-built rental. Rough numbers. Demand for high-rise construction comes from, in other words, 6/7 of it comes from sales. So construction usually doesn't happen for about a year after sales, right? So we follow the sales market religiously, right? Because that is telling you what the demand's going to be in a year's time, give or take a year's time, right? Purpose-built rentals have shorter horizons for making investment decisions. So if you want to understand what's going to happen in construction costs, you need to understand what's happened a year ago and such in the sales market. So the sales in the last year, the average sales for the period 2016 to 2021 was 2,000 units a month in the GTA, blended. Obviously, some months higher, some months lower. Some years higher, some years lower. From January 22 to July 22 was 2,500 a month. Then in August 22 is when the sales plummeted. And the average sales in the last 12-month period is 1,000 units a month. Right? So it's down 60% from the first part of last year, and it's down 50% on a blended average. And those numbers are the only reason it's the decrease is not as high is we had a very good April, May, and June this year when everybody thought rates had leveled off, and then we had 2 more 25% basis points reductions, and sales dropped off the shelf again. So everybody right now is deferring launches. Not everybody, but a lot of people are deferring launches that they already deferred from last fall to this spring to this fall, and now they're deferring it till next spring. Construction of a typical project, I know there's different scales of project, but a typical project is give or take 3 to 4 years, right? And so the trades are telling us right now they're so busy they can. There's no people in the union halls practically, right? And I'm saying, well, you should be busy because you're building what was sold in 2018, 2019, 2020, 2021. They're only just starting the 2022 sales that were good for the first half of the year. So construction costs in the last year have increased about 4%. And in the preceding year, they increased about 16%, right? And in the preceding 5 years before that, they averaged between 8 and 10% a year, right? on a go forward base, so that's big picture, right? And everybody talks about when are construction costs coming down? And construction costs are made up of three components. This is on a micro level, and this is the level you have to look at it. It's made up of materials, labor, and profit. And I'm going to use round numbers, but materials and labor, call it 45% each, and profit or overhead. Their overhead and profit, call it 10%. So labor costs are dictated by union agreements. We all know what's happening. We got 3-year rolling agreements. We know next year they're going to increase next May 1 about 4%, and the following May 1 it's even going to be higher because they back-ended most of the increase to the third year. When I say higher, we're like 4.5%, 5%. So if you take 4 to 5% and 45%, that's a 2% increase. Then you look at materials. Materials have largely leveled off. Some have actually come down, like rebar. Some have gone up, like glass. But generally speaking, they've more or less gone flat. And the material costs are going to be dictated by the general economy. And the general economy is doing not too bad, right? Notwithstanding this interest rate hikes, although there will be a bit more pain felt. So then we're down to profit, and that's only 10%. So like, how much movement can you have that's going to impact construction costs? Certain trades, and I don't want to name them, but they know who they are, have excessive, they've done very well over the last several years, right? Other trades have got killed during COVID. The COVID material cost surge where they allowed 3% per annum in their bids, and it ended up being 60% and roughly half their contract value. And they couldn't recover it from owners. They're able to get partial recovery from if the owner contributed to the delay, or if the owner accommodates them with just giving them some money to try and keep them alive. Relationship and such. And so we see construction costs in the next year, notwithstanding that demand is going to go down, right? We don't see the ability for the trades to really reduce costs, right? And if anything, we're calling for a 3% increase in this forthcoming year. This is not like, I went through the 90s, the 1980, late 89 to 94, 95. And in 1990, construction costs fell over a 3-month period by about 35%. It's not going to happen this time. It's a totally different environment. Interest rates are, even though we're up at 7.2% prime, it's a lot less than 14% that it was back then. We got a huge underlying demand requirement from population growth, and we've also will have gone through 2 years of poor sales, and therefore there's less being built. And the economy is doing reasonably well. So it's a totally different environment. But we're in for pain over the next continued pain over the next year, and I think it'll take a year to recover after that, because
it's a lagging factor.
The lag factor.
As I listen to you talk, I'm curious because I totally appreciate the condo sale halt just because of what's going on in the marketplace, but rental rates still remain strong. Are there pivots? Are there condo starts that are saying, okay, well, wait, maybe I should just continue to build, but just turn it into an apartment building?
I would say on about 25% of pro formas we're looking at these days, different from before, where it might have been only about 10%. Owners will say, can you run us a rental option too? You got to appreciate that most of these people have never done a rental. And you say, happy to do it. Just before we start, I just want to tell you one thing. You're going to need double the equity.
You can't get it back.
You don't have deposits. You don't have purchaser deposits. What? I say, yep. So, you're going to do half the number of projects because you need, you essentially need to.
Is that how it specs out ultimately?
If you look at a capital stack on a condo project, and I'm generalizing, right?
Yeah, of course.
But equity is typically 15%. Deferred costs are 3%. That's sales commissions and such at the back end. A loan is give or take 65, and it's inching higher, 67%. And deposits are about 15%. So on a rental project, you take away those 15% deposits, you got 30% equity, and you've no deferred costs.
And you don't cash out at completion either.
And you don't cash. You got to refi down the road once you stabilize it. So that usually sort of ends the discussion pretty quickly.
Do you find it's a different cost altogether? I mean, we always hear from our apartment developers that it's more expensive to build apartments because you got to build higher quality, because you got to own it for a longer period of time. You can't commoditize it. Like the condo developers are always, cutting corners to make it as cheap as possible.
I'll say
that's the narrative.
Two things on a construction cost basis we're talking here, and then we'll talk soft cost. But on construction costs, first of all, if you're building a 600 unit condo, which is the average size now in not as much in the suburbs, certainly within the 401, and you're building a 600 square foot rental, your construction cost for a rental, it's going to be about 2 or 3% more. Why? Because they put smart locks in the door, they put floor drains in the laundry, in their in-suite laundry. They put LVT flooring down instead of laminate flooring, and they do a couple of other things, right? However, it's not a fair comparison because rentals are not 600 square feet. Rentals are typically 20% larger. Your average rental unit is about 20% larger than your average condo unit. So we would see an average rental unit being in the same market, in the same street, same location, being about 750 square feet instead of 600 square feet. So when you increase the unit size, you decrease the costs because you have less kitchens, less bathrooms, less fan call units, less all the expensive touch points in a suite, less suite entries. So it drives the cost down. And a rule of thumb is for every 100 square feet, it's probably around 40, 50. Sorry, I just was waving at somebody there.
That's the problem recording at conferences.
But you're going to be about $15 a square foot less for building a 750 versus a 600. So therefore, when you net that against the higher costs, it's actually cheaper to build a rental per square foot than a condo. But they're not the same square footage. That makes sense?
Understood. Yeah, no, makes sense.
On the soft cost side, before Bill 23, which has had a very positive change on the rental side of the performer, not on condos, but largely on the rental side, you saved what you saved on commissions and what you saved on legal fees and a few other things like carry-on and such. It was offset by your operating costs, your operating loss to break even, and also by your HST and your deemed disposition comes into the budget, right? So it's a sort of a trade with Bill 23, the DC relief on rentals, on purpose-built rentals, is very welcomed, and I'm actually being quite not heavily, but involved with a working group within the industry. I mean, there's enough media about it now, but there's efforts being made to try and get some HST relief on purpose-built rental, and we'll see. It's
is that the Real Pack housing accord that was just discussed, or something else
today?
Yeah,
I didn't hear that, so I don't know.
Okay.
Yeah.
So Aaron and I are lenders, as everybody knows. What are you seeing lenders do now? What is a riskier market to manage risk with construction projects? Because of course, construction is riskier than stabilized product, and we're in a riskier market, and lenders like to retreat a little bit in the face of some of that. So what are you seeing lenders do to manage risk differently in the last year and a half as opposed to prior markets?
Well, my first comment would be that. And this is not trying to butter up to the lending community, but I think the lending community, particularly in the GTA market, and generally speaking in Canada, although there are exceptions, has been has been a big contributor to the success of the real estate business. Because there's good checks and balances, and there's very good discipline as a result of what the lenders require with pre-sales and their different various conditions precedent. And I've worked in other countries, and worked on projects in other countries while living here in Canada, and it's not the same amount of discipline. Offsetting that, what I would say, it's like any business that's competitive. In the previous 6 or 7 years to this one, standards got a little lax, and competition, mainly because your competition got so high, right? And some bad habits sort of crept in. Now the opposite is happening. There's a greater focus on preconditions, and we're certainly seeing, there's minimum contingencies that lenders are looking for. There is definitely, look, when someone gets in trouble, they do weird things. Right? You really don't you don't know a person until they're in trouble, right? and so you need checks and balances in there. You definitely need, in this market, you need to go backwards and do your cross off the cancel check review and make sure that the money you gave them went to where it's supposed to go.
Yeah.
And you may have thought that was being done before, but it wasn't.
Well, it wasn't. No, we're well aware of that.
Yeah, and you need to get on. You definitely need to get on top of that. And to be quite honest with you, you need people to be advising you on what's real out there, as opposed to what they're being told is real by
Yeah, well, I'll ask you
another
that question.
party.
Once we hit stop on the record button, we'll have a better conversation. Sorry for everyone who's listening. We're almost out of time, Niall, so I want to just finish up here. What's keeping you up at night? We're in a really kind of weird situation. We're still heading downwards at the end of the last cycle. The new cycle hasn't started yet. It may get a lot worse, but we hope not. How concerned are you, and what's the biggest worry for you?
The ability of developers, borrowers, to be able to handle the budget increases and that they're being asked for, and hopefully, it's an industry, right, where everyone's working together trying to be successful, and I think we got a really good industry here, and respectful, and it's not. The solutions aren't black and white. It's people losing control, and then that sort of it doesn't as much keep me up at night, because we like to be quite factual. It's just the resolutions of of the findings that we have, bother me, because it's.
Yeah. I think there's some pain coming in the marketplace. Is that kind of what you're leading to?
Oh, I think the pain's been here for the last year and a half almost. It's even longer with the construction cost problems and DC issues. But
Well, how messy is it being a QS on a project that's failing?
Or will fail as you're kind of reviewing
You see it popping up in the numbers.
Well, the best advice is to tell people not to proceed with projects in due diligence, and we're somewhat of a dream crusher on many jobs, because people come in very excited and
I bought this land. I
I
want
know.
to do this. And
Developers by nature are very optimistic.
I'm not a stock promoter. They got to know, because
it's just
the
math.
best money they can spend is the money they don't spend, and realize it early. And that's not, look, I would say the more projects I look at in due diligence don't make it out of due diligence and do make it out. And it's not just for what our findings are, maybe findings that the owner uncovers elsewhere, but that's the best time to deal with issues. Now, when you're pregnant with the job and it's underway and you got to proceed, it's and I could say almost every project's had budget overruns, largely because of interest in the current day, and previously because of construction costs and DCs in particular. But you can be very, very proactive if you know what the issues are coming up, and you have and there's a good team in the project, you can overcome a lot of challenges. You just got to be, you got to have that advanced knowledge and say, well, if you don't do this, this is what's going to happen. So now is the time to deal with it. So we spend an awful lot of time, particularly early in projects, before they even get to a loan stage, looking at efficiencies of building and, why are they doing this and why are they doing that? That won't work. And it's like simple, like things like, not seems simple to us, but like, parking. Like, it was a project yesterday I brought up with an owner. I said, look, with all due respect, you're overbuilding your parking here, because Jimmy down the road doing this project, and we were working on it, and they just started selling 4 months ago or 6 months ago. The parking demand's only 0.6. You're building 0.8 for, like, you don't need it. And they go, oh, well, that's normally what we build. And say, well, like, you're going to have empty parking stalls, and that going to cost you a lot of money. And so it's things like that, and the design of the floor plate, and why is it's inefficient? Okay, why is it inefficient? My guys will measure it. They'll say, okay, we're coming in at 74%. It should be normally at 77, 78, whatever it is. Okay, so you got to start attacking it. Well, why? Why is that happening? And looking at the design, and then bring it to the attention of the owner, and then they, then they'll go to work on it. But if you don't do those type of things, that won't happen. And it doesn't look an awful lot of owners. You don't need to do that. They know what they're doing, right? But some people, you got to help them, and that's the enjoyable part of the business.
As often as you're saying no, it's the times
it's
where you're able to help
enjoyable.
people. Yeah.
Oh yeah, that's what you're trying to do. You're trying to make it. The product's going to be the exact same at the end. You're not cheapening the product. I mean, saving money is not about switching from limestone to brick. It's from designing
it can mean the
efficiently.
difference between it being built and not being built.
Yeah,
which
exactly.
Is material.
Yeah, more built is more fun, but none of it goes under. Niall, we're out of time. This is super interesting. It's topical, as Aaron mentioned. We've got a large construction pipeline at First National, so we spend a lot of time thinking about this stuff. But it's great to hear it straight from the expert. We, of course, want to thank Real Estate Forums for hosting us here today at the Canadian Department of Investment Conference, Kingset Capital for sponsoring the video web series, First National for powering the podcast. But again, most of all, thanks, Niall.
Appreciate it. Thank you.